What's up, guys? Are you new to the world of investing? Don't be nervous. Regardless of how much money or expertise you have, you may learn how to invest confidently so that you can amass a sizable nest egg for the future. We frequently hear the terms stock market and stock exchange used in the media. Students and young professionals alike often inquire about the best practices for making money investing in stocks. But if you have zero experience, don't worry. In this video, we will talk about investing in the stock market with zero experience. So before starting this video, please like the video and subscribe to the channel for future updates. Oh, and make sure you watch to the end so that you get all of the vital information.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, money, money.
Alright, let's look at brokers. The very first thing to consider is a broker. Brokers are classified as either full-service or cheap brokers. By its name, full-service brokers provide a comprehensive range of traditional brokerage services, including financial planning for retirement and healthcare, as well as general financial advice on a wide range of topics. Clients of high net worth are typically only dealt with by these firms, which demand hefty fees that include a percentage of your transactions. That's right, a percentage of your assets that they manage, and occasionally a yearly membership fee. When it comes to full-service brokerages, it's not uncommon to find minimum account amounts of $25,000 or higher. On the other hand, traditional brokers justify their high fees by providing extensive advice tailored to your specific requirements. Discount brokers were once the exception, but they have become the rule. Discount online brokers provide you with the tools you need to pick and place your own transactions. Many of them also include a Robo Advisory service that you can set and forget. The evolution of financial services in the 21st century has seen online brokers add more features to their websites and mobile applications, such as instructional content on their sites and apps. Furthermore, although several cheap brokers do not have, or have shallow, minimum deposit requirements, you may be subject to additional restrictions. Some fees may be imposed on accounts that do not have a minimum deposit requirement. This is something that an investor should keep in mind if they plan to make a stock market investment decision. So now we're going to look at buying a stock mutual fund. Mutual funds are a collection of assets managed by a financial professional on an ongoing basis. On behalf of the investor, shares in mutual funds are purchased and sold by a fund family, such as Fidelity, Vanguard, or Charles Schwab. These types of mutual funds available include stock mutual funds, bond mutual funds, and specialty mutual funds. Mutual funds of stocks are investments composed of hundreds or thousands of different equities belonging to various businesses. It could be exclusive to foreign, domestic, significant, minor, or growing enterprises, or a mix of the two. It may only invest in stocks of companies in specific industries such as utilities, real estate, gold mining, or information technology. Having many individual equities within a single investment provides immediate diversification while also reducing risk over time. Yes, some equities held inside a fund may experience a decline. Still, the losses may be compensated by gains in other stocks held within the fund. When looking at the names of stock funds, look for phrases like large cap, mid cap, and small cap. CAP is an abbreviation for market capitalization, which refers to the value of a company's stock shares on the open market. Large cap mutual funds only invest in large corporations such as Apple, Target, and General Electric, or their subsidiaries. Let's take a look at buying a stock index fund. In the stock market, index funds are mutual funds that aim to replicate or beat a market index, such as the Standard & Poor's 500 indexes, or the S&P 500. They possess huge, diversified portfolios of individual stocks, the value of which generally rises over time as the market does. Actively managed index funds do not attempt to earn quick gains by regularly purchasing and selling underlying investments instead of passively managed index funds. Investing in index funds is a convenient approach to gain exposure to a broad range of markets. Furthermore, because they do not have large teams of research analysts or huge running overhead, they may charge comparatively minimal prices to their clients. How about buying a stock exchange traded fund, or an ETF? The similarities between an ETF and a mutual fund are obvious. because both are collections of underlying assets such as stocks, bonds, real estate, commodities, currencies, or other investments. Both provide you with affordable and convenient diversification through the use of exchange-traded funds. However, unlike mutual funds, ETFs are traded on a stock exchange, just like stocks, allowing you to follow their price and buy or sell them at any time the market is open. Because this information is available daily, you will always know which firms or assets you own if you invest in an ETF. Many mutual funds only disclose their portfolio holdings a few times a year, which is unusual for the industry. As a result, you will never be left in the dark regarding where your money is exactly. Compared to substantial mutual fund families, exchange-traded funds or ETFs often don't acquire and sell investments as frequently or have as much overhead to accomplish their objectives. The savings are passed on to investors in the form of dividends. As a result, many ETFs charge cheaper fees when compared to the average mutual fund. Furthermore, several investment analysts have discovered that passive funds, such as exchange-traded funds or ETFs, and index funds, generate superior returns over time than actively managed funds. Have you ever heard of a target date fund? These funds, also known as life cycle funds, are some of the most innovative and up-to-date funds now accessible. Mutual fund and exchange-traded fund families will likely make them available to you. Funds invested in target date funds have various assets, including equities, bonds, real estate, and cold hard cash. The fund manager gradually alters the asset allocation to match a specified time frame, such as your anticipated retirement date. A target date fund is distinguished by including a year in the fund's name, such as Retirement 2030 Fund or Retirement 2055 Fund. Among other things, the date you choose should correlate to when you expect to take a break from work. Example, if you're 35 years old and planning on retiring 30 years from now in the year 2052, choose the fund with the closest target date to your retirement date. Let's take a look at Robo Advisors. Immediately following the global financial crisis of 2008, a new kind of investment advisor emerged, the Robo Advisor. It is widely believed Betterment was funded by John Steen and Eli Broverman, who were among the first in space. Their objective was to employ technology to minimize expenses for investors while also streamlining providing financial guidance. Several other robo-first companies have been started since Betterment's inception. Even major online brokers such as Charles Schwab have begun to offer robo-like advice services to their clients. Charles Schwab has published a survey stating that by 2025, 58% of Americans intend to employ some form of automated advice. Using a robo-advisor may be right for you if you want an algorithm to make financial decisions for you, such as tax loss harvesting and rebalancing your portfolio. A robo-advisor may also be a superior option if your objective is long-term wealth accumulation, as seen by the success of index investing in recent years. One such example is M1 Finance. Several features distinguish M1 Finance from other robo-advisors. M1 Finance is entirely free and has a large number of features. They have obviously designed their platform to be user-friendly for both novice and more experienced investors, giving you the option to either set it and forget it or be more involved in your trading operations. M1 Finance is highly recommended by us for all investors. M1 Finance was founded in 2015 and has quickly risen to become one of the world's most popular automated investment platforms. Many people believe that M1 is the ideal combination of a regular brokerage firm and a hybrid robo-advisor. The investment portfolio template is what distinguishes M1 from the competition. Your investment alternatives are displayed to you as investment pies or pie charts, representing the breakdown of your investment portfolio when you are setting up your investments. This is an excellent method of visualizing a portfolio, in our opinion. We appreciate the versatility of selecting pre-built expert pies for beginners and the ability to design your own pie from scratch for the more hands-on investors. You'll probably start by listening to what other people are purchasing and selling. That's fine, but don't expect to do so for very long. You will eventually need to devise your own stock market approach. To make money in the stock market, there are a variety of strategies to invest and trade shares. Each is best suited to a specific personality type, and you must locate one that works for you. It will take some trial and error at first, but if you are patient and learn from your mistakes, you will eventually profit. And that's it for today. What did you think of our video? Go ahead and let me know down in the comment section below. If you enjoyed this video and you want to hear from us again, be sure to hit that subscribe button before you go. As always, thank you for watching.